So let's proceed with the Chapter 2 exercise involving T accounts. The first thing I want to note is that I've kind of scrunched my screen together a little bit, so it looks a little differently from your notes at the moment. And that's just so I have everything on one screen here for you. So without further ado, let's jump into this question. The first thing we're going to look at is the list of transactions which we must produce T accounts for. So, for instance, letter A, on January 1st, 2019, an entrepreneur, Lori, invests $5,000 into her new business. So, thinking back at some of the questions we've done in Chapter 1 and Chapter 2, we should be familiar with this idea now that investing cash into a new business results in the cash account going up. So let's go ahead and make our first T account, and it will be for cash. So that's account 1 set up. And if you want to go ahead and put DR and CR on the left and right side respectively, you can go ahead and do that. I'm not going to do that because it's just going to make things a little bit too congested, but you can feel free to do that on your own paper, the same way we have DR and CR for the cash account just above this question in your notes. So looking at transaction A, we will be adding 5,000 into Lori's new business. Before we do that, we're just going to get into the habit of putting down the beginning balance first. Now, in this case, it's not absolutely essential because it's a new business. Everything starts from zero. But just to show you how it's done, we're going to go ahead and do that. Beginning balance. January 1st. And we're going to put a dollar sign on the left side since cash is typically a debit account in its normal state. So we have a beginning balance of zero. Now that we have that set up, we have the name of the account up top and we have a beginning balance. We can go ahead and post transaction A to the T account. So the way I like to do that is just have a quick reference to the transaction. So I do this by putting a lowercase a, and I'm not going to write a dollar sign again. I'm going to go straight into the number $5,000. All right. So that's our debit of transaction A all done. What we need to do now is make the credit entry. So as we discussed, an investment into a small business results in an increase in capital, and capital is essentially equity. So we're going to set that up over here, and we're going to label our T account correctly as Lori, comma, capital. So when capital goes up, it ends up being a credit. But before I do that, I'm going to once again make a beginning balance. for January 1st. It will of course be $0. Now that we've done that, we can make the credit entry for transaction A, which is $5,000 under Lori Capital. So that's quite straightforward. We're done A. Now let's look at B. January 5th, 2019, Lori visits the bank and secures a loan of $4,000. So presumably, you all know enough about banks to know that when you take out a loan, you get cash. So once again, we're going to have a debit to cash. So we'll go over there and again start with your lowercase letter and just punch in $4,000. The credit side is a little more interesting. This is going to be a liability because of course we have to pay the bank back. So we'll go ahead and make a liability account. We can just simply call it bank loan, or you can call it bank loan payable. I'm just going to go ahead and put down bank loan. And once again, we'll start with a beginning balance on the credit side, seeing how it's a liability account. Remember to put in the date, and then you can go ahead and record transaction B, the credit side. So we're starting to see the T accounts come together nicely. As we go to the list of transactions, we make our T accounts. A grouping of T accounts like this is called a general ledger. So let's look at transaction C. On January 12, 2019, Lori purchases merchandise inventory on account for $2,500. There's a few things going on here. One, we're adding an asset to our small business. And second, we have to take note of the two words over here, on account. So on account can mean a couple of different things. In this case, it's account payable. We will be owing somebody money after this transaction. So let's go ahead and make our new T accounts. The first one will be our asset account. It will be inventory. So inventory are products which we buy and hopefully sell for more to our customers. So beginning balance here is going to be a little bit tight because it's on the left side. So we'll go ahead and write a little bit smaller here. $0. And now we've added some inventory in transaction C. So go ahead and post that on the debit side, $2,500. Now we can go ahead and make our second liabilities account for this list of transactions called account payable. And once again, we will have our beginning balance on the right side, as this is a liability account. So it's a natural state is a credit state. And we're going to go ahead and make a credit entry for transaction C, $2,500 in account payable. D, this is where it gets really interesting. We have a customer come in named Eric, and he purchases $1,000 worth of goods on account. And the goods had cost Lori $700. So a couple of things of note here. First, we have that interesting phrase again, on account. In this case, it's going to be accounts receivable because someone has purchased from us. They owe us in the future. The second interesting thing of note here is that we have a couple numbers in this transaction. One is $1,000, which is what we sold the goods for, and we also have 700, which we bought the goods for originally. So keeping those two things in mind, let's proceed with this transaction. The first thing we will do is we will make our accounts receivable T account. And once again, we'll have a little bit of a crunch here as we squeeze in a beginning balance. Not too bad this time. Asset account beginning balance starts off on the left side, and then we can go ahead and post the first debit of transaction D right over here of $1,000. This is our newly created asset, which is an amount of money that Eric, our customer, now owes to us. So whenever we make a sale, we have to recognize revenue for that sale. So let's go ahead and make a new T account here called sales revenue. And recall that revenue is at the top of your income statement and it is a credit balance. So we will put down the beginning balance here on the right side, starting off with, of course, 0. And we'll go ahead and make our credit entry, or first credit entry, I should say, for transaction D. And there, the first entry is now all done. A debit to accounts receivable for the amount of the sale, 1,000, and a credit to sales revenue, also for 1,000. Now we have to deal with the 700, which was our original cost. So what we have here is an expense account called cost of goods sold. And this account reflects what you paid for something that you sold. So in this case, we paid $700. So we'll go ahead and record that. And when we sell something, where does it come out of? Well, it comes out of our inventory. Right? Once it's sold, we no longer have it. So we'll go up here and we'll make a credit to inventory to decrease it by the amount of $700. Now that's all fine and dandy, but it looks a little bit confusing. We have a whole bunch of these. Some of them are 1,000, some are 700. So what I like to do is add a tiny little number next to the letter to reflect which debit matches up with which credit. So in this case, we have 1,000 debit and credit. So we'll put a 1 over here, and we'll put a 1 over here. Make sure I get that. So D1 reflects the first half of the transaction, which is the sale price. And this one's going to be a little bit tough, so I'm going to go ahead and rewrite this D over here. That should help us a little bit. And we'll put a 2 down here next to these two. And now we have a couple of these. D1 matches up with the $1,000 amount, and D2 matches up with the $700 amount. Now we're going to look at transaction E. Lori pays her supplier for the January 12th purchase. So going back, just to remind ourselves what January 12th was, it was a merchandise inventory purchase on account for $2,500. So you do have to pay your supplier at some point. So we're going to go ahead and make this payment. So we pay with cash. That's the cash account going down. So we'll make a credit over here for $2,500. And since we've made that payment, we no longer owe that money. So we'll go down to account payable and make a debit on this side to kill our owing balance. And finally, F, January 31st, Eric pays for a January 15th purchase. So recall that Eric owed us some money, and the transaction is right here. Eric purchased $1,000 worth of goods on account. So let's go and record that collection. That will be cash coming in. So cash account will go up by 1,000. And Eric no longer owes us money. So we'll put a credit entry here. We're essentially trading off one asset for another. So now comes the fun part. We posted all the transactions. Now we're going to calculate ending balances. So recall that we add up both the debit and credit side of each T account, and we post an end balance on the side which is bigger. So starting with cash, which is probably going to be the trickiest one of the lot, we have 5,000, 4,000, 1,000. Our debits add up to 1,000. We have a credit of 2,500. So that 2,500 goes against the debit balances. So we end up having a net debit balance of 7,500. As the final number, you want to put a $sign, put a double underline, and also write down end balance January 31st. At the end of the month, we tally up our T accounts. So let's go ahead and do that for Lori Capital. This one's very straightforward. It's just one number on the credit side. And once again, we're going to label it as an ending balance on January 31st. Again, bank loan, it's no challenge here at all, no real math involved. And let's look at inventory here. I'm going to cheat a little bit. I'm going to write it over here because I'm painfully low on white space. And we do need to do some math here. We have debits of 2,500. We have credit of 700, which gives us a debit ending balance of 1,800. Dollar sign, double underline. Now we're going to account payable. Here the debits and credits are equal. So we'll be writing our 0 on the natural credit side. Accounts receivable also ends up even. So we'll have our end balance of 0 on the natural debit side, with this being an asset account. Sales revenue, everything is on the credit side, so it's a quick and easy process here. $1,000 ending balance. And finally, cost of goods sold. We have 700 on the debit side. Can't really get the double underline there, but you get the idea. I'm going to cheat a little bit, write down my ending balance on this side. And this video will run quite long, so I'll stop there and let you make your corrections or changes to your T account, and we'll start again in the next video.